Question number 6. On 1st Jan 2018, an investor has a portfolio of 5 shares as given below. Security A, B, C, D, E, price, number of shares and beta. The cost of capital to the investor is 10.5% per annum. You are required to calculate the beta of his portfolio, theoretical value of Nifty futures for February 2018, the number of contracts of Nifty the investor need to sell to get a full hedge until February for his portfolio if the current value of Nifty is 5900 and Nifty futures have a minimum trade lot requirement of 200 units. Assume that the futures are trading at their fair value. The number of future contracts the investor should trade if he desires to reduce the beta of his portfolios to 0.6. Number of days in a year be treated as 365. Given natural log of 1.105 is equal to 0.0998 and e raised to is given. Okay. So 1st Jan 2018 la investor have a portfolio of these 5 shares. First question, we need to compute the beta of his portfolio. So beta of individual shares and so portfolio and a beta and again we can take the weighted average. So we can write the security, price, number of shares. Then we can compute the value, which is price into number of shares. So the total value will be this much. And we can assign the weight. Weight is equal to, weight for A is equal to 17,46,500 divided by total value. അതേപോലെ വെയ്റ്റ്സ് എഴുതാ, the total of the weight should be 1. Then beta of each investment we can write. Then weightage into beta. So total is 0.849. Portfolio beta is 0.849. Then second part, theoretical value of Nifty futures for February 2018. So February 2018 la theoretical value kandudikkan. Theoretical value means the future value as on Feb 2018. Second part, calculation of theoretical value of futures. So cost of capital is given as 10.5% per annum and it is compounded annually. And here we are given the natural log of 1.105. Okay, so natural log of 1.105 is 9.98% and they are continuously compounded. We can use this 9.98% as R. So E is equal to P into E raised to RT. P is 5900 given in third part. Current value of Nifty 5900 into E raised to 9.98% into T is, this is for February 2018. So 1st Jan 2018 to Feb 2018, 58 divided by 365. So future value is 5994.28. The number of contracts of Nifty the investor need to sell to get a full hedge. Full hedge in normal beta is equal to 0. So how many contracts the investor need to sell until February for his portfolio if the current value of Nifty is 5900 and Nifty futures have a minimum trade lot requirement of 2000 units. Assume that the futures are trading at their fair value. So when the total portfolio to be hedged and required beta should be 0. So when it has to be fully hedged, the required beta should be 0. So future contract value is equal to value of portfolio into existing beta minus required beta. Chamber, you will get the future contract value. So when the total portfolio have to be fully hedged, the beta have to be 0. So number of contracts in the total value of future divided by contract value. So total value of future is value of portfolio into existing beta minus required beta. Value of portfolio we already calculated into existing beta also we computed. So value is 1,88,54,860 and beta is 0.849. So substitute amber, you will get the future total value as 16,776.14. That divided by lot size into future value. What is the lot size? 200 units. And future value is, you already calculated after February, it is 5994.28. So you get the number of contract as 13 contracts. Fourth part of the question is the number of future contract the investor should trade if he desires to reduce the beta of his portfolio to 0.6. So the number of future contract the investor has to trade. New beta is 0.6. Required beta is 0.6. So number of contract is equal to value of portfolio into existing beta minus required beta 0.6 divided by future value into contract size. So number of contract is 4 contract. Question number 7. On April 1, 2015, an investor has a portfolio consisting of 8 securities as shown below. So security, market price, number of shares and value is given. The cost of capital for the investor is 20% per annum continuously compounded. The investor fears a fall in the price of the shares in near future. Accordingly, he approaches you for the advice to protect the interest of his portfolio. So cost of capital is 20% per annum continuously compounded, and the investor fears a fall in the price of shares in future. You can make use of the following information. Current Nifty value is 8,500. So current value is 8,500. Nifty can be traded in units of 25 only. So lot size is 25. Futures of May are currently quoted at 8,700 and futures of June are being quoted at 8,850. So futures for May ഇന്റെയും futures for June ഇന്റെയും present value തന്നിട്ടുണ്ട്. So futures of May ഇന്റെയും futures of June ഇന്റെയും values തന്നിട്ടുണ്ട്. We are required to calculate the beta of this portfolio. So first beta compute ചെയ്യാൻ we are given the number of shares, then market price. So we can get the value, then multiplied by beta ചെയ്യുമ്പോൾ you will get the value beta. So total value beta divided by value ചെയ്യുമ്പോൾ you will get the portfolio beta 1.102. The total value is 9,94,450 and the portfolio beta is 1.102. Second, the theoretical value of futures contract for contracts expiring in May and June. So May and June will expire ആകുന്ന future contracts in the theoretical value. So theoretical value is A is equal to P into E raised to RT. So future value, first one, futures expiring in May കണ്ടുപിടിക്കാം. So Mayയിൽ expire ആകുന്നതിൻ്റെ present value is 8,500. So 8,500 into E raised to R. R is the rate. Rate is 20% into T is the time. So time എന്ന് പറയുന്നത് as on 1st April ആണ് ഇൻവെസ്റ്റ്മെൻറ്റിൻ്റെ ഡീറ്റെയിൽസ് തന്നിരിക്കുന്നത്. ഇത് എക്സ്പയർ ആകുന്നത് മെയ്യിലാണ്. സോ ഏപ്രിൽ മെയ് 2 മാസം. സോ 2 divided by 12. So 8,500 into E raised to 0.0333. സോ അതിൻ്റെ വാല്യൂ നമുക്ക് തന്നിട്ടില്ല. അതിന് പകരം E raised to 0.03യും E raised to 0.04 തന്നിട്ടുണ്ട്. So we can use the interpolation formula to arrive at 0.0333. Okay. So 0.04 minus 0.03 is equal to 1.04081 minus 1.03045. Okay. So ഇതെന്ന് പറയുന്നത് 0.01 is equal to 0.01036. രണ്ട് സൈഡും 0.33 വെച്ച് മൾട്ടിപ്ലൈ ചെയ്യും. സോ അങ്ങനെ ചെയ്യുമ്പോൾ 0.0033 is equal to 0.00342. So E raised to 0.0033 is equal to 0.00342. Then E raised to 0.03 ൻ്റെ വാല്യൂ നമുക്കറിയാം. So E raised to 0.03 plus E raised to 0.0033 is equal to 1.03045 plus നമ്മൾ കണ്ടുപിടിച്ചത് 0.00342. So we arrive at the value of E raised to 0.033 as 1.03387. So for futures expiring in May, 8,500 into E raised to 0.0333 is equal to 8788. Okay, then theoretical value of futures expiring in June. So 8,500 into E raised to R, rate is 20%, into April, May, June, 3 months. So 3 divided by 12. So you get the futures theoretical value as 8,935.80. Okay, then third part. The number of Nifty contracts that he would have to sell if he desires to hedge until June in each of the following cases. So number of contracts കണ്ടുപിടിക്കണം. In each following case, total portfolio 50%, 120% of portfolio. So how do we calculate the number of Nifty contracts? So number of contract is equal to value of portfolio into beta divided by value of future contracts. So first case, value of portfolio. So value of portfolio is 9,94,450 into beta is 1.102 divided by value of future contract. So value of future contract is It is keeping till June. So June future value is 8,850. So 8,850 into lot size etrayana. Lot size is 25 into 25. So you get the total portfolio basis 5 contracts കിട്ടി. Then 50% of portfolio basis ചെയ്യാനായിട്ട് അതിൻ്റെ 50%. So same formula into 50%. അതേപോലെ തന്നെ 120% return into 120%. So we get as 5 contract, 3 contract and 6 contract respectively. A rice trader has planned to sell 22,000 kilo of rice after 3 months from now. So after 3 months from now, a rice trader want to sell 22,000 kg rice. The spot price of the rice is 60 per kg and 3 months future on the same is trading at 59 per kg. So the spot price is 60 per kg and future is 59 per kg at spot date. Size of the contract is 18,000. Size of the contract is 1,000 kilos. The price is expected to fall as low as 56 per kg 3 months hence. So they are expecting that the price will fall as low as 56 per kg. What the trader can do to mitigate its risk of reduced profit? If we decide to make use of the future market, what would be the effective realized price for its sale when after 3 months spot price is 50 cent per kg and future contract price for 3 months is 58 per kg. So after 3 months spot price is 57 and future 58 per kg ആയിരിക്കും. Okay, so first part, what the trader can do to mitigate its risk of reduced profit. So on a future date, the price is going to reduce, so they will take a short position. So the trader need to take a short position on rice futures at the rate of 59 per kg for 22 contracts. Because the price is going to fall down at 58 per kg, they don't need to hold this position. So the trader have to take a short position on rice futures. And after 3 months, what will be the realizable value എന്ന് ചോദിച്ചിട്ടുണ്ട്. So spot price after 3 months the spot price is 57 per kg and we are selling 22,000 kgs. So 22,000 into 57 per kg, 12,54,000 will be realizing. അതുകൂടാണ്ട് gain on future, gain on this exercise എത്രയാ 59 നാം exercise ചെയ്തേ 58 ആണ് after 3 months ഫ്യൂച്ചറിൻ്റെ വാല്യൂ. So there is a gain of 1 per kg. So 1 into 22,000. So total realization is 12,76,000. Effective selling price realized will be 12,76,000 divided by 22,058 per kg. So in this case, on a future date, price കുറയും. So price കുറയുമ്പോൾ we are gonna hold a short position. So trader need to take a short position on rice future. And after 3 months, 3 months spot price 50 cent per kg realize ചെയ്യും. അതുകൂടാണ്ട് ഈ ഓപ്ഷൻ ഈ ഫ്യൂച്ചർ എക്സസൈസ് ചെയ്യുന്നവരുണ്ട് ഒരു 1 റുപ്പിയുടെ ഗെയിൻ ഉണ്ട്, അതും റിയലൈസ് ചെയ്യും. Question number 9. A future contract is available on R Limited that pays an annual dividend of 4 rupee and whose stock is currently priced at 125. So future contract ആണ്, annual dividend 4 rupee pay ചെയ്യുന്നുണ്ട്, സ്റ്റോക്കിൻ്റെ current price is 125. Each future contract calls for delivery of 1,000 shares to stock in 1 year, daily marking to market. So marking to market means on a daily basis the prices get adjusted to fair value. The corporate treasury bill rate is 8%. Required given the above information, what should be the price of one future contract? So one future contract in the price എങ്ങനെ compute ചെയ്യും? We can use this formula. Future value is equal to present value into 1 plus R percentage minus dividend. Present value, current rate is 125 into 1 plus rate is 8% minus dividend is 4. So you get the price of future contract as 131 per share, which has to be multiplied by the number of shares 1,000 to get the future price as 1,31,000. Second part, if the company stock price decreases by 6%, what will be the price of one future contract? So stock price 6% reduce ചെയ്യും. So ഇവിടെ തന്നെ price 6% reduce ചെയ്യുമ്പോൾ it will be how much? 125 minus 6 percentage, which is 125 into 94 percentage into 1 plus rate minus dividend. Future price is 122.9 per share. The total contract value or share value will be 122.9 into 1000, 1,22,900. As a result of the company's stock price decrease, will an investor that has a long position in one future contract of R Limited realizes a gain or loss? What will be the amount of his gain or loss? So ഇവിടെ പറയുന്നത് long position will result in a loss in case of price decrease. So when the price decreases, long position will result in a loss. Only when the price is expected to increase, we will hold a long position in the market. If we are expecting the price to decrease, we will hold only short position. So in this case, the price is decreasing, so we won't hold a long position. The long position will result in a loss. So long position will result in a loss in case of price decrease, and the amount of loss will be 1,31,000 minus 122,900, 8,100.